Good day, everyone. You're welcome to this week's Business and Investment Tips program, a production of RCCG Christ Church Radio with Dr. Ayodeji Ebo, an investment professional. This week, we focus on Nigeria's economy through the World Bank's lens, key stats, and insights. Last week, the World Bank Group released the latest edition of Africa's Pulse, a report that provides new insights into economic developments across major African countries, including Nigeria. Published biannually in April and October, Africa's Pulse serves as the World Bank's flagship analysis of macroeconomic trends, policy changes, and critical challenges in the sub-Saharan Africa. The main goal of this report is to offer timely, data-driven insights that can guide policymakers, investors, and development stakeholders. On this episode, we will highlight key findings from the report as they relate to Nigeria's economy. 1. Growth on the upside. Services sector leading the way. Nigeria's economy finished 2024 on a stronger note than many analysts had anticipated. Real GDP growth rose to 4.6% in the fourth quarter, up from 3.1% in the third quarter. The primary driver of this growth was the non-oil sector, particularly the services industry, which expanded by 5.4% year-on-year. Key contributors on the growth included financial services and ICT sector, reflecting a rise in digitization and fintech activities. For investors, this highlights the services sector as a robust growth engine that warrants attention in portfolio decisions. 2. Oil sector recovery adds support. The crude oil sector has returned to growth, increasing by 5.5% in 2024, thanks to a recovery in production volumes, which rose from 1.47 million barrels per day in 2023 to 1.55 million barrels per day in 2024. Although this remains below pre-pandemic levels, it marks progress in the right direction. In addition, the industrial sector grew by 2.4%, indicating that Nigeria is gradually working towards a more balanced economy despite ongoing challenges such as oil theft and inadequate infrastructure. 3. Improved business sentiment and demand. In March 2025, the Stanbic IBTC Purchasing Managers Index (PMI) reached 54.3, indicating a significant improvement in business conditions. This increase reflects higher sales and a surge in new orders driven by renewed demand and various new project commitments across different sectors. This signals rising business confidence and economic momentum for investors and entrepreneurs as we move into 2025. 4. Inflation still a concern. Despite expectations that inflation might ease due to base effects from the Naira depreciation in early 2024, both headline and core inflation rates remain high, recorded at 2.04% and 2.54% month-on-month, respectively, in February 2025. Ongoing inflationary pressures continue to challenge household incomes and business costs. Therefore, investment strategies must remain mindful of inflation, particularly in areas related to pricing, procurement, and consumer-focused sectors. 5. Growth outlook. Moderate but steady. The World Bank estimates that Nigeria's economy will grow by 3.6% in 2025 and by 3.8% from 2026 to 2027. The services sector, particularly finance, ICT, and transportation, will be the primary drivers of this growth, with oil production expected to stabilize around Nigeria's OPEC plus quota. This indicates moderate yet steady opportunities for long-term investors, especially in service-related equities, digital infrastructure, and transportation logistics. 6. Rising poverty remains a red flag. A significant concern highlighted in the report is that poverty levels in resource-rich but fragile countries such as Nigeria are projected to increase by 3.6 percentage points between 2022 and 2027. This trend makes Nigeria one of the few countries in the sub-Saharan Africa experiencing worsening poverty. Investors and policymakers must find a balance between promoting macroeconomic growth and ensuring inclusive development, along with making social impact investments. 7. Current account and Eurobonds update. There's some positive news on the external front. Nigeria's current account surplus is projected to increase, rising from 9.2% of GDP in 2024 to 9.4% in 2026. This growth is driven by a decrease in imports and an increase in diaspora remittances, which serve as a confidence booster for foreign exchange reserves and currency stability. However, Nigeria's return to the international capital markets has yielded mixed results. While the country successfully raised $2.2 billion through Eurobonds, its first issuance since 2022, the cost of borrowing remains significantly higher than levels seen before the pandemic. This reflects ongoing investor concerns about fiscal sustainability and associated risk premiums. Here are the key takeaways for investors. Nigeria's macroeconomic landscape is emerging from a phase of turbulence, slowly but steadily finding its footing on the path to recovery and rebalancing. Within this evolving narrative lies genuine opportunities, particularly in the vibrant services sector, the rapidly expanding digital economy, and critical infrastructure development. However, investors should remain vigilant. The specter of persistent inflation, surging poverty rates, and high debt servicing costs casts a shadow over the encouraging prospects. This underscores the importance of strategic and foresighted investment planning, ensuring alignment with the country's long-term economic trajectory. Thank you for listening. Please join us same time next week for another interesting and insightful session. For questions, comments, and feedback, kindly forward to ebo.ayodeji@gmail.com or send an SMS to 07082463747. Stay blessed and have a great week.